Welcome to the DoughRoller Money Podcast. My name is Rob Berger, and today in episode number 204, we're going to talk about student loan repayment plan options. I had an opportunity to look through some of these. I'm at an age where I'm long past worrying about student loans, thank goodness. It took me about 20 years to get out of my student loans from law school, but I had a chance to look at the options that are available for folks that have graduated trying to pay off their student loans, and I got to tell you, it is a complicated mess. So today on the show, we're going to talk about it. The good news is I'm going to show you a tool, an online tool that you can use to sort of sort through this mess. If you've got student loans, or maybe you're a parent and your children have student loans and you're trying to help them, it's a very easy tool to use and to compare the half a dozen or so, I think there's even more now, payment options or repayment options, so you can figure out what's best for you. So that's going to be our main topic for today. I'm also, after that, going to respond to a couple of listener emails that I received that I thought were very interesting and wanted to share those with you. And before we get to all that, I wanted to cover a couple of items in the news. First of all, I'm recording this just a day or two after, I guess 2 days after the Super Bowl. The Broncos beat the Panthers. Did you see the post-game interviews? Cam Newton took a big hit because in the post-game interview, I guess he went in. I didn't actually see it. I read about it, but he went in with the reporters. He was late getting there, had a hoodie on, staring at the floor, no eye contact, one-word answers. Not so good. I got to tell you, I'm rooting for Cam Newton. I'm a Peyton Manning fan, so I was actually happy to see the Denver Broncos win. But going forward, I assume Peyton Manning is going to retire. But I'm rooting for Cam Newton. You know, the thing is, he obviously didn't take that loss as well as maybe we'd like to see him take it. I'm guessing, although I didn't see this post-game interview either, but I'm guessing if you go back a couple of years to Peyton Manning's post-game interview when they got shellacked by the Seahawks, I mean, that wasn't even a game. I'm guessing he probably handled himself a little differently. You know, of course, he's 39, got a few years of experience over Cam Newton. But I would have liked to have seen Cam Newton handle that, no doubt, upsetting and difficult situation a little better. But what'll be interesting is to see how he performs next year and the years after that, because, you know, we learn the most from experiences like that, from failures, right? From the hard times. It's great to have the successes, and we hope to have those in our lives, our careers, whatever. We got to have some of those, hopefully. But you learn from your defeats and your failures. You know, I learned far more. This may not be as important as the Super Bowl, but I learned far more from a game of chess that I lose than one that I win. And fortunately, I've got a lot of chess games that I've lost to learn from. But I'll be curious to see how he handles himself going forward and into next year, and if he's a better football player because of that experience. I assume he will be. I try to apply that to my own life. You know, it's the failures that teach us the most. And anyway, speaking of failures, let's talk about the first news item here. This is in the Financial Times. It's about robo-advisors, automated investment services. We've talked about them: Wealthfront, Betterment, Wise Banyan. There are a number that are out there. And the news article was this, that, the market has obviously been down and very volatile this year in the first part here of 2016. And apparently the robo-advisors are a little nervous that, they've built up, several billion in assets over the last few years, but they're concerned that in the volatility in the down market, a lot of the investors are going to flee and take out their money. And so they're working hard to calm investor fears. They've apparently been receiving far more phone calls than they normally receive, and so they've been dealing with that. And it's an interesting time now because the robo-advisors started and launched and came up during a time when the market was on a tear and doing very, very well. And so the question is always, well, how are investors going to deal with a down market that use robo-advisors? And, there's some that think you're far better off with an actual human being investment advisor to keep you from making a bad decision during a down market. I'm actually not convinced of that either, because in 08, 09, investment advisors lost tons of clients and tons of assets under management as people left the market. So they weren't able to keep their clients in the market. And the studies that I've seen on this actually say that there is one group of investors that do better than the average at sticking to their investment plan during a down market? Any idea what kind of investor does that? Well, hopefully it's folks that listen to this podcast, but that's not actually what the study said. The study said those that invest in index funds. I thought that was pretty interesting. In any event, robo-advisors are a little nervous that investors may flee. If you use an automated investment service, Betterment, Wealthfront, whatever, I hope you stick to your plans, your investment plan, your asset allocation, whether the market is up or down. And again, I'm assuming that you're a long-term investor, which in my mind is at least 5 years. Every dollar you have in stocks, in my view, should stay in the market. You should plan to have it stay in the market at least 5 years. If you're going to need it sooner than that, it shouldn't be in stocks. I've read just the other day, Warren Buffett, I think this was from some time ago, but he said, look, you can turn a great investment into a very risky transaction if you plan to invest in a stock for the short term. He said, if you invest in Coca-Cola today with a plan of selling it tomorrow, that's a very risky transaction. On the other hand, if you invest in Coca-Cola today with a plan on keeping that investment there for at least 10 years, it's not a very risky investment at all. Now, by the way, I think he said that some time ago. I'm not sure what his view of Coca-Cola as an investment is today, although Berkshire still owns a significant amount of stock in Coca-Cola. Anyway, I thought that was interesting, and it'll be interesting to watch how the automated investment services do, in a very difficult market. Hopefully they do just fine because their investors stick with their investment plans. I guess we'll see. The next item I wanted to mention, this deals with your 401k. There was a study that basically concluded investors make smarter investment decisions inside a 401k if they have fewer choices. Give them too many choices, and they tend to make not so good decisions, particularly when it comes to investing in mutual funds that charge high fees. What they found is if they cut the options in a 401k in half, and the investors were forced to pick new investments, they would tended to pick low-cost mutual funds, even if high-cost mutual funds were still part of this, reduced number of investing options. There were still plenty of high-cost options available, but they tended to pick the low-cost options, which I found to be an interesting study. I wonder, though, if it's not because there are fewer options, but rather because when they were kicked out, so to speak, of their old investments because they were being taken out of the 401k and they were forced to put that money in new investments, they took that opportunity to say, well, golly, maybe I should take a look at some of these things and see what's best. And they gravitated towards the low-cost options, which tells me it's so easy to sort of forget about that 401k, but we shouldn't. Not that we have to check it every day, but we should know what our money's invested in, what the fees are. Obviously, we've talked about this time and again in this podcast. But if you're listening and you say, Rob, I don't have a clue, and I've talked to people that say this, they don't know what mutual funds they're invested in or what their fees are. If you don't know that, log into your account. It's very easy to figure out the fees. Worst case, take the ticker. For a mutual fund, it's going to be 5 letters. Take the ticker of each of the mutual funds you have money invested in your 401k, and just Google the ticker, and it'll probably come up right in Google what your expense ratio is at the top. If it doesn't, go to Morningstar.com, put the ticker in. They will tell you. It's very easy to do, but I found that to be a pretty interesting study. I also think over the last 5 or 10 years, there's just particularly 5 years, there's been a lot more. People to do that? Well, no, they don't. No, not all investment advisors, investment professionals, I guess I should say, are fiduciary. Now, that doesn't mean they can just put you in whatever they want. There is a rule that says if they're not a fiduciary, the investment they put you in has to at least be suitable for you. But that's not as a tough a standard to meet as a fiduciary. And what this article says is, and this is kind of interesting, the effect this rule could have is to prevent a lot of advisors from putting their clients in variable annuities. Why? Well, because a variable annuity is effectively an insurance product, and they, when someone puts you in, when an advisor says, you need a variable annuity, the way that advisor makes money is the insurance company pays them a fee, and at least according to this article out of the Wall Street Journal, those fees averaged in 2014 8%. So if someone took $100,000 of your money and put it in a variable annuity, they got paid $8,000 for that. That's not a bad payday. I kind of like that. Maybe not so good for you and me, but I mean, if I were in some sort of investment professional selling annuities, that's not a bad deal. And apparently, under this new rule, that's not gonna. You can't work that way. Now, I bring this to your attention to say one thing. There's this notion. It's very easy to say, yes, everyone should be fiduciaries. They should have our best interests at heart. But we got to be careful with that. There are plenty of investment advisors, fee-only investment advisors, who would say, I'm a fiduciary. I don't get paid by those big, nasty insurance companies. I don't get paid by anyone other than you. So I have your best interests at heart. Now pay me 1.5% of your assets every year for the rest of your life, which is effectively what many of them do. To me, they don't have your best interests at heart. I mean, they may not violate the fiduciary standard. But look, anyone charging you more than 1%, and even that's high, but I'll just draw the line there, charging you more than 1% to take your money and stick it in 5 mutual funds, they don't have your best interests at heart. That's my view. That's just absurd. It's highway robbery. I don't know why, why would we throw our money away like that? Now, if you want help, that's great. There's plenty of ways to get help for less than 1%. And I mentioned Vanguard, 30 basis points. But if you don't want Vanguard, there are other options. My friend Rick Ferry at Portfolio Solutions. Now, you have to have a fair amount of money to make this work. I would say at least $1 million, so that doesn't apply to everyone. I get that. But I think he's like 38 basis points maybe. But there are plenty of investment advisors out there that are, even 20 to 50 basis points. And then, of course, you've got the automated investment services that we've talked about. So plenty of ways to get help at less than 100 basis points of your assets under management. I guess the point I want to make, though, is just because someone's a fiduciary, just because someone is a fee-only advisor, doesn't make them a good deal. And that you need to keep that in mind. We talk about Dave Ramsey every now and again. He has his endorsed local providers, and they put you in actively managed funds that charge a front load, usually 5.75%. I'm not a fan of that, but I will tell you, you're probably better off in that kind of investment than you are paying someone 1.5% or 2% a year to put you in index funds. You're going to end up with more money with one of Dave Ramsey's endorsed local providers than you are paying someone 1.5% to 2% a year forever, at least as long as they manage your assets, to stick your money in some index funds. So just because someone's a fee-only advisor, just because they call themselves and even meet the fiduciary standard, doesn't mean they are the best for you, the best option. You got to look at those fees. You got to keep them as low as you reasonably can. All right, on to student loan repayment plan options. So before we dig into the details, one thing I want to say here is this. Over the last year or so on the blog, or even more than that, I write a lot of the content myself, but I started to rely more and more on other people to write the content for me. And in fact, if you've listened to the show for a while, I called out for folks, for all of you, if you were interested in writing, to email me, and I've gotten a lot of responses and have actually started working with a number of you to write content for DoughRoller and have had some articles published. One of the things I wanted to do was to get, experts. So for example, the lawyer that I used to write our wills now writes for DoughRollers, 1 article a month. In fact, we posted published her first article in January dealing with when you should get a will. And so that's been great. She's going to have, I think in February, we're going to publish an article from her on who you should set as your beneficiary in a 401k or an IRA. So really practical stuff that I think requires more expertise than, someone like me. So I'm not a trust and estates lawyer, and she is. So that's worked out great. But the reason I bring all this up is there's so much in personal finance and investing. There is absolutely no way one person can cover it all. It's just impossible. I could spend 24 hours every day of the week, and I couldn't I couldn't do it. And so one of my writers, her name is Abby, and she is terrific. She lives with her family in Indiana. She and I have worked together for a number of years, and she just does some great work. I don't know if she listens to this podcast. Abby, if you're listening, you do a great job. Maybe I should just write her a letter and tell her, maybe an email. Anyway, one of the things I asked her to write about was student loan repayment plan options, because they just seem to get more and more complicated, and there seem to be more and more options. Certainly more options today than when I was repaying my student loans. And so she put together really a fabulous article, very detailed, on how to pick the best student loan repayment plans. And as I was looking at it, I was reading it. Of course, I read all content. Even if someone else writes it, I read everything that gets published on DoughRoller, as you might imagine. Wow, this is something. I don't know how you get your arms around this. And I was reading through her article. It starts out, there's the standard repayment plan, which is basically a 10-year repayment plan. Then there's the graduated repayment plan, which can go up to 30 years for consolidated loan. Then there's, the extended repayment plan. Then you get into things like revised pay-as-you-earn repayment plan, pay-as-you-earn repayment plan, income-based repayment plan, income contingent repayment plan. I'm like, holy cow. And then, of course, there's the income-sensitive repayment plan. I'm pretty confident they didn't have that one when I graduated from law school in 1992. Maybe they did. I just didn't know about it. The first thing is she has done a great job of going through each one of these and walking you through what they are, how they work, what you should know about each one. Now, in this podcast, I'm not going to go through all of that. If you want to see this, of course, just go to the blog and read it. If you haven't seen this article, I would highly encourage you to sign up for the newsletter. It's free. You can sign up at DoughRoller.net/newsletter. It goes out every Saturday at 7 p.m. It includes a lot of things, but one of the sections is simply links to articles that we've published the past week on DoughRoller. And so if you're subscribed to that, you look at it, read the email each week, you won't miss content like this. But she just did a great job. And I thought to myself, as I'm reading through this article, this is all fine and well, but how do you make a decision? How do you even compare, one option to all the others? And so I'm scrolling through the article. Well, lo and behold, Abby answered that question. It turns out there is a great tool offered by our government that helps you figure out what's best for you. And it's called the Federal Student Aid Repayment Estimator Tool. Is that a mouthful? Federal Student Aid Repayment Estimator Tool. There is a link in the article to the tool. Of course, if you haven't read the article, or maybe you're listening to this podcast, in 2017 or beyond, just Google Federal Student Aid Repayment Estimator Tool. And the way it works is you can either log into your accounts and it sees all your federal loans and can populate the tool, or you don't have to log in if you don't want to, and you can enter your loans manually. But what it does is it shows you, and let's see, there's 3, 4, 5, it shows you all 7 repayment plans. And then it compares each one. It'll show you, based on the information you've put into the system, what your first monthly payment will be, the amount, what your last monthly payment will be, because in some cases, they go up, right? It depends on the payment plan you pick. It'll show you the total amount you've paid, projected loan forgiveness, because in some cases there can be some loan forgiveness, and then of course your repayment period, how many months it will take you to pay off your debt. Now, the thing that I found interesting about this tool, and again, I was trying to rack my brain to remember back when I was paying all my student loans, but there are, depending on which payment plan you pick, there are going to be some interesting factors that go into your payment, like where you live, right? Of course, your income, that's obvious for some of the income-based repayment plans, and your family size, right? They factor that in as well. And what Abby did in this article is she put in some sort of hypothetical scenarios to compare the different repayment options. And what I found fascinating is the monthly payment can vary significantly based on the payment plan. And of course, the total amount you'll end up paying, principal and interest, can vary significantly. And of course, your payment period. So as an example, in the article, you'll see a hypothetical debt of $25,000 on a federal direct unsubsidized consolidation loan with an interest rate of 7.5%. And I should say all these repayment plans apply to federal student loans, not private student loans. So these are federal student loans. But there's one for $25,000, 7.5% interest. If you assume, you file jointly with your spouse, you have combined income of $50,000, and you live in Indiana, with your 4 kids. That was the hypothetical. Well, the first monthly payment can vary from as low as $114 to as high as $253. That's the big difference. In this case, the lower payments were on the revised pay-as-you-earn payment plan, the pay-as-you-earn plan, and the I think one other. Let's see here. Yeah, income-based repayment plan. The highest one was for the income contingent repayment plan, $253. Now, at first glance, it may seem like you might want to go with the smallest payment, and maybe you should, but of course, the smaller the payment, you tend to end up paying more in interest, and it takes you a longer period of time to pay off the loan. But that's the great thing about this tool. It lays all this out for you. For example, the way to pay off the loan the quickest and for the least amount of money is this income contingent repayment plan. Of course, that would cost $253 a month. Eventually, the last payment is estimated at $270. You pay it off in 146 months. Boy, that's a long time. And you pay just over $38,000. But, if you compare that to the income-based repayment plan, you start off with a much lower monthly payment, $114, but you end up paying, let's see here, almost $11,000 more in total money paid out, $49,813, and it takes you 212 months to pay it off. So I thought this tool was excellent. I wanted to share it with you. I know student loans, are a difficult thing for a lot of people. As you try to deal with that, you're dealing with your student loans while you're trying to save for retirement and maybe your own children's education and buy a home and all of this sort of thing. And I think this is a great tool. You just got to balance what you can afford on a monthly basis, right, with paying as little interest as you can and perhaps getting out of your student loan debt as quickly as you can. Now, the other thing I'll mention is in this article, she covers another scenario. In this scenario, what if you only make $30,000 a year, not $50,000? Well, it changes the numbers dramatically. And in fact, there are 4 payment plans where to start with, you pay nothing, absolutely nothing. Now, again, you're going to end up potentially paying more down the road, except that for some of these plans where you pay nothing up front, there can be some loan forgiveness. So in those cases, they might be the best option. Again, the only way that I can think of to do this is for you to use the federal student aid repayment estimator tool. It's the only way you're going to sort through all of these options and figure out what's best for you, or perhaps for your child if they're having graduated from college, or maybe just kind of thinking ahead and trying to figure this out. It is a great tool. I wanted to share it with you. And again, the article that Abby wrote, if this is of interest to you or someone you know and you've not read it, absolutely, I think it's worth the time to do so, and even forward to other folks if you know they're going to be dealing with student loans. I got to tell you, I don't think we had these calculators. Well, I know we didn't have them when I graduated in 1992 because Al Gore had yet to invent the internet. All right, that was a cheap shot. But we didn't have the internet, and we didn't have all of this sort of functionality. But it's a great thing, so you might as well use it. It's the only way I think you can sort through all of this without going crazy. All right, now let's move on to some listener questions. Actually, I have one great question, and then another listener we had a back and forth, but he shared an experience he had getting a mortgage that I think could be helpful to a lot of people. So let's start with the first question. It came from Zach. He said, "Love the show. Keep up the great work. I have a 403B from my old employer in a Vanguard Target Retirement Fund with about $8,000. I also just opened a Roth IRA at Vanguard and have the same Target Retirement Fund and contributed $7,500. I maxed out contributions for 2015 and got a jump start on 2016. The question, would it make sense to roll over the 403B to the Roth IRA and take advantage of the compounding effect of a large amount in one account? Or do you think the tax effects of going from the 403B to Roth IRA would have a significant impact for this tax season? Appreciate any advice. Thanks, Rob." Okay, great question, Zach. And it actually kind of raises a couple of questions that we need to unpack this and look at some things separately. So let's first make sure we're all on the same page with terminology. So a 403B is just a workplace retirement account. It's very similar to a 401k. You'll find them at nonprofit organizations. My wife had a 403B when she worked for an adoption charity. And but 403b and 401k basically the same thing. And then he mentions a Roth IRA. So we know an IRA, an individual retirement account, or actually an individual retirement arrangement, but an IRA. And the Roth simply means that you put in after-tax dollars. You get no tax break for contributing into a Roth IRA, but your money grows tax-free. So when you take it out in retirement, you don't pay any taxes on all of the earnings, appreciation, dividends, interest, whatever. And so his first question is, I've got one account with 8,000, one with 7,500. Should I combine them to take advantage of the compounding effect of a larger amount in one account? So let's talk about that first of all. You'll get no compounding benefit by merging two accounts, right? If you've got them invested in the same investment, the fact that they're in two different accounts is not a disadvantage. They will compound separately, but at the same rate. Again, we've got the money invested in the same Vanguard retirement fund. Putting them together won't increase the effect of the compounding just because it's a larger amount. So you won't get any advantage there. Now, there may be reasons to roll it over, right? You may not like your investment options in the 403b. Doesn't sound like that's the case here. But, for others, you might not like your investment options. Maybe the 403b or 401k charges some administrative fee that you want to get out from under. Or maybe you just want to combine your accounts so that management of your investments is a little easier, right? So there are all kinds of good reasons to roll over a workplace retirement account either into an IRA, or maybe you roll a 401k, an old 401k into your current 401k. That can be done in some cases. But it won't boost the compounding effect. You're still compounding the same total dollars with the same return from the investment. The fact that the dollars happen to be held in two different accounts doesn't change anything. Now, on to the sort of substantive question: should he roll over a 403b to a Roth IRA? So on a sort of technical side, my guess is if he wants to do that, he would have to roll a 403b, and I'm assuming it's not a Roth 403b. But if it's a traditional 403b, he would have to roll it, I'm guessing, into a traditional IRA and then convert that over to a Roth. But that's, I guess, just a technical thing. He could certainly get this money into a Roth IRA. The question is, would the tax impacts make that a bad idea? Well, there's no way for me to answer that, right? I don't know what the tax implications are for him. I don't know what his marginal tax rate is. As a general rule, I think those that are in the lower tax brackets will benefit from Roths, and those in the upper tax brackets will benefit from pre-tax or traditional accounts. Those in the middle, it just probably depends on a lot of different factors, including your state income tax, where you think you might live in retirement, which you, of course, may have no idea. I do think that at the end of the day, if you think it's a toss-up, the tie goes to the runner in baseball. In retirement investing, the tie goes to the Roth IRA or 401k, in my opinion. But whether that's a good deal for Zach, there's just no way for me to answer it. It might be something you want to try to puzzle through yourself, or maybe talk to a financial planner or your tax person. But you need to look at what tax implications there would be for converting it to a Roth. Would that bump you into a higher tax bracket, for example? And what would the impact of that be? What do you think your future taxes are going to be? Are you just starting your career and you're in the lower tax brackets and you expect to get raises and make a lot more money and be in higher tax brackets down the road and in retirement, or not? So those are the sort of the things you need to think about. And also you may choose to convert some of it in 1 year and some of it another. You don't have to convert it all at one time if that's what you end up deciding to do. And, the other thing to keep in mind is some of this is your best guess, because we're trying to understand and predict what will happen in the future, right? In order to assess whether it's a good move now. And we have imperfect information. We don't know what the tax brackets are going to look like. We don't know what they're going to look like next year, let alone 10, 20, 30, 40 years from now. And it's oftentimes hard to predict your own career and, how much money you're going to make. So, it's you have to make the best decision you can with imperfect knowledge. One of the things that some folks do because of that is not only, you think about diversifying your investments, stocks, some bonds, U.S. stocks, international stocks, and so on. Some people diversify on a tax basis. They say, I don't know what the future is going to hold, so I've got some in a Roth and some in a traditional, and that's okay too. But there, it's not an easy question to answer. Again, if you're on the fence, I would prefer the Roth. But again, I think having a little bit of both is fine too. And of course, if you're in the upper brackets, it may make more sense just to take the tax benefits now of traditional accounts. Anyway, great question, Zach. Appreciate it. Sounds like you're doing a great job saving. Keep up the good work. All right, the next one comes from Tim. And Tim and I had a back and forth. He emailed me a sort of a long email that dealt with this. He locked in a rate for his mortgage. And if you've ever dealt with this, you can lock in a rate for like 30, sometimes 45 days. And that gives you time to get to closing on the home you're going to buy without worrying that your mortgage rate is going to go up if rates should go up during that time period. Well, of course, some people say, well, wait a minute, what if rates go down? Am I stuck with this rate? If I got, let's say, 4%, and they go down to 3.5% before I close, I want that lower rate. And so what a lot of mortgage companies will do is say, well, we'll give you one chance. One time during this period, you can get the lower. If it goes down, you can get the lower rate. You can lock in that lower rate one time during your 30-day lock period or 45-day lock period. And so that's what Tim had signed up for. And the rate, sure enough, went down 50 basis points. And so he called his mortgage company all excited. I want that newer, lower rate. And they said, well, not so fast. We've talked to our manager here. And because of this issue and that issue and this issue, we can only lower it 25 basis points. You don't qualify for that 50 basis point drop. You will drop at 25 basis points. So Tim emailed me and asked me what I would do. And I would fight that, right? And I told him that. I said, and I would even consider a complaint with the CFPB because I just, and I certainly at a minimum want a better explanation than what they had given him. I said, but I'm not you, and you do have to balance that with the risk that your deal could fall through. I don't know what kind of mortgage company he's dealing with. Are they legitimate up front or not? Or, are they trying to pull a fast one? It's kind of hard to tell. And Tim emailed me back. He had a better idea. He got his realtor involved, which is, absolutely, why not? And they basically told the mortgage company, look, we think what you're doing is wrong, and we're willing to walk away from this if we have to. And sure enough, the mortgage company caved and gave him his 50 basis point drop, which, on a mortgage is huge, depending on how long you live in the home. But 0.5% is a lot of money over the life of a mortgage. And so it was a big deal for him, and I was glad to hear that it worked out for him. But I thought I wanted to share it with you. It's a great tactic. You're in a real estate transaction. You're paying a realtor, by the way. I don't care which side of the transaction you're on. You're paying a realtor, right? Because the money may be paid by the seller, but it's all getting factored into the deal they're willing to make with you. So you're paying for a realtor one way or another, and they know the business. Hopefully, you've got a good realtor. They know the business. They know the mortgage business, and they should be able to help you out. And that's exactly what happened in Tim's case. And so he turned out to get the deal that he was promised and the deal that he deserved to get. And that's all we can ask for. So good job on that. Tim, appreciate you writing in. So there you go. That's it for today. You can reach me at DoughRoller.net. Now I've been telling a lot of folks when they email me with questions, post it in the Facebook group. I simply am overwhelmed with email. I'm already behind in email. I just can't keep up. And I do read every single email, but I oftentimes will reply, and I'm going to be honest with you, it's a template reply that says, great question. I encourage you to join the Facebook group and post it there because you'll get a much faster response and you'll get responses from a lot of different people. And I'm monitoring that Facebook group as well, and I respond many times. But that's really the best way. If you have a question, is to reach out to that Facebook group. If you haven't joined it, it's just you go to DoughRoller.net/Facebook group. And that will redirect you to the Facebook group page. You can join it, and it's a very active and a great bunch of people that are trying to help each other out, make the most of their money. So I would encourage you to do that. Hey, hope you have a great day. Until next time, remember, the best thing money can buy is financial freedom.